morning, everyone. In today's class, we will study the third basic variance, variable overhead variance. So let's see what is the first variable expenditure that is incurred when the production starts. Okay, so the production has started, the machinery is working fine, and all the lights have been lit up. So one of the variable overheads, electricity charges, is being incurred now. Let's look out for the other variable overheads. So this lady is using cleaning liquid and the supervisors are using lubricants for the machine. Now my question is, will variable overheads be incurred, that is electricity charges, cleaning materials, lubricants, if laborers are not there? What is the answer? The answer is variable overheads will not be incurred if the laborers are not there, because it is a laborer who's switching on the machine. It is laborer who's switching on the lights. They are the ones who are using the cleaning materials and the lubricants. So if they are not there, obviously variable overheads will not be incurred, which means that variable overheads will only be incurred when the direct laborers are working. Now, my next question is, when there is idle time, will variable overheads be incurred? Think. Now, what is idle time? Idle time is when a machine breaks down and the laborers are unable to do their work. That is idle time. So just visualize that situation. When there is idle time or when there is a machine breakdown and when the laborers do not have any work to do, what do they usually do? They can go home. They can go home and relax. And when the laborers go home, do you think the electricity charges will be incurred for running the machine? Do you think there will be cleaning expenses that will be incurred? Do you think lubricants will be used for the machine? Absolutely not. Which means that when there is idle time, variable overheads will not be incurred. That is, variable overheads will be incurred only for the actual hours worked by the laborers. This is a very important point. Let me write that in red. So always put in your mind, variable overheads will be incurred for the labor hours actually worked. Now we will come to the formulas of variable overhead variance. Now the short forms that have been used in the formulas are SR for standard rate, AR for actual rate, SH for standard hours, and please note it is the standard hours of labor, and AH for the actual hours worked. Here again, it is for the labor. Now, what is variable overhead variance? Just like any other variance, it is the difference between the standard cost and the actual cost. And what exactly is standard cost? Standard cost is standard hours multiplied by the standard rate. And actual cost is the actual hours multiplied by the actual rate. Variable overhead variance is divided into two. One is the expenditure variance and the other one is the efficiency variance. In the expenditure variance, what are we trying to measure? Whether the rate paid for the variable overheads is more or less than the standard. So it is standard rate minus the actual rate multiplied by the actual hours of labor worked. And in efficiency variance, what are we trying to measure? Whether the time taken is more or less than the standard. It is standard hours minus the actual hours. We get the variance in hours. To convert it into dollar value, you have to multiply it with the standard rate. Now, since the format method is much faster, we will adopt the format method. So let's see how the format method is done. So variable overhead total variance, what is the formula? Standard hours into standard rate. That's the standard cost minus actual hours into actual rate. That's the actual cost. So in the format, we will be writing the standard cost on the bottom, that is SH into SR, and actual cost on the top, that is AH into AR. And what is the difference between the two? That is nothing but the variable overhead total variance. And if the top figure is more, that is if the actual cost is more than the standard cost, then it is an adverse variance, just like the formats that we studied earlier for direct material and direct labor. Now coming to the two split formulas, that is the expenditure variance. What's the formula? It is standard rate minus the actual rate multiplied by the actual hours. Now I'm opening the formula. So it is actual hours into standard rate minus actual hours into actual rate. Now we're coming to the next formula. Efficiency variance, what's the formula? It is standard hours minus the actual hours multiplied by the standard rate. Here again, opening the brackets, we have SH into SR minus AH into SR. If you notice the two formulas, AH into SR is common for both. So I'm going to write that in the center of the format so that on the top portion, we get the expenditure variance, and in the bottom portion, we get the efficiency variance. And always note that actual hours is the actual hours worked by the laborers. So this is the final format of variable overhead variance. Please note that with or without idle time, the format remains the same. The only thing that you have to notice, actual hours is the actual hours worked. Now coming to the question, extracts from the standard cost card of a product are direct labor 2 hours. What is this 2 hours? 2 hours is the time taken for making 1 unit. Multiplied by $15 gives a direct labor cost of $30 per unit. Now variable production overheads, the hours are missing. What does that mean? Is the question incomplete? No, it is the standard hours of direct labor, which is the standard hours for variable production overheads also. Okay. Now, during May, 200 units were produced. What do you mean by this 200 units? 200 units is the actual production. The direct labor hours were paid $6,600 for 440 hours of work. That is the actual hours paid to the laborers. But the idle time records shows the 20 hours in the month were recorded as idle time. So which means that the number of hours for which the laborers have actually worked is 440 minus 20, or only 420 hours. Okay. Actual variable production overheads incurred was $1,530. Calculate variable overhead variances. Now, a word of caution, do not take standard rate or actual rate of direct labor for variable overheads. This is a common mistake that many students do, because when they are doing it fast, they tend to take the standard rate of direct labor, because in the question, the standard rate of direct labor and the standard rate of variable overheads will both be given. Now, if you see here, standard rate of direct labor is $15. This is of labor, okay? And $4 is the standard rate of variable overhead. The 4 details that we need for tackling the problem: standard rate, standard hours, actual rate, or we could also have actual hours worked into actual rate, because what is actual hours worked into actual rate? That is nothing but the actual variable overheads. Because in most of the questions, the actual variable overheads will be directly given in the question. Now, in this question, it is $1,530. So why take the extra effort to calculate the actual rate? That is why I have mentioned that. Calculate variable overhead variances. Now, the first detail, standard rate. What is the standard rate? It is $4. So I'm keying in that figure. Next, coming to standard hours. 1 unit takes 2 hours. So 200 units takes how many hours? Working note 1, it's 2 into 200 or 400 hours. I'm keying that 2. Now, actual hours worked into actual rate. That is the actual variable overhead expenditure is given directly in the question at $1,530. So I'm going to key in that. So I'm just striking out the actual rate. Alternatively, you could also calculate the actual rate. Now coming to actual hours worked. 440 hours is the actual hours paid and 20 hours is the idle time. So what is the actual hours worked? It is 440 minus 20 or 420 hours. So I'm keying in that too. Now, just for your information, we could also calculate the actual rate and key in the format. What is the actual rate? It is $1,530. That is the actual variable overheads divided by the actual hours worked of 420. So you will get the actual rate. Now, the calculation of actual rate is not necessary because we can get the variance by just substituting this total figure, that is actual hours worked, into actual rate. So if you calculate the actual rate, it is an additional step. So you can easily avoid it and still get the very same answer. Now we've got all the details to fill up the format. So going to the format, we have the first item that needs to be filled in is actual hours worked into actual rate. That is given directly as $1,530. So I'm keying in that figure. Now actual hours worked into standard rate. Actual hours worked is 420 and standard rate is 4. So you get 420 into 4, which gives an amount of $1,680. Next, coming to standard hours into standard rate, SH is 400 and SR is 4. So 400 into 4, you get $1,600. Now coming to the expenditure variance, it is $1,530 minus $1,680. So since the top figure is less, it is a favorable variance of 150. Next, coming to efficiency variance, it is 1680 minus 1600. And since the top figure is more, it is an adverse variance of 80. And variable overhead total variance, it is 1,530 minus 1,600. And since the top figure is less, it's a favorable variance of 70. If you cross-check, 150 favorable plus 80 adverse gives an amount of 70 favorable. So our answer is right. With this, we come to an end of today's session. So I hope the concept of variable overhead variance is clear for you. If you have any doubts, do post it in the comment box below. And if you've understood the concepts well, do click the like and the subscribe button. So see you in the next video.